Welcome back to F.A.C.E, David.
Good to be with you, Dale. How are you?
Good. Oh, look at that pensive look as you look up
Hello.
at the tape. There's Steve. Steve is saying hello to you, David. Welcome back to F.A.C.E.
Dale,
Good.
just a fast interruption. We're getting data just to
Okay.
productivity minus 4.2 versus minus 4.7. US labor costs revised lower to 6 versus 6.6. And for some reason, we don't have the jobless claims and the continued jobless claims out, although they were supposed to come out along with the rest of the data. They seem to be a little bit delayed.
Okay. Thanks for that update, Steve. So, David, you want to share your screen? My trading warrior brother.
We just got it 745 versus 750. So, yeah, as expected.
As expected. Yeah.
All right. So, David, I think the market's in a little different shape than the last time we talked. There was a break and then one more push to new highs up around that 3960 level, and NASDAQ really, led all the way up, and it seems to be leading on the way down, kind of reverting to the mean on its outperformance to the general market. So what are you thinking in here, David? We're underneath the 50-day, just barely holding on to this 38 support. I'm looking for 3,000 by the late summer, fall. I know that's an aggressive target, but wondering what you're thinking here, if the top is in or you need more confirmation.
It's a great take, Dale. And I would say for every stock like Facebook and Amazon that breaks below its 200-day moving average, for every stock that is unable to hold its 50-day moving average, like the S&P may, do today and tomorrow, we'll see what happens. That's when a target like S&P 3000 seems less and less unlikely. The more breakdowns you see, the more breadth divergences you see, that's where further downside seems more possible. And the way that I think about, market direction, as most technical analysts do, is it's all about probabilities. We don't know exactly what's going to happen tomorrow or next week or next month, but
we know anything and everything can happen. That's
exactly right. And it's all about the likelihood of certain things happening and betting on different scenarios. And for me, there's a non-zero and growing possibility that we have a materially lower move from here. But Ned Davis used to tell me all large losses begin as small losses. So the key is, the key is now sort of focusing on when things are breaking down, right? Things don't go to zero before they break down a lot of key support levels along the way. And that's why the chart of the S&P, it's not totally broken yet. It's just, it is half broken,
Right.
We've broken down through the first trend line, this pink trend line on my chart, which is taking the October low to the December low. That lined up with the mid-January low. We hit it again in late January, and then we broke through it. That was the first, sort of real indication in my mind that things were starting to change a little bit. We had one more high, but it sort of tested that trend line from below, and then we rolled over again. Step two is the 50-day moving average, and we're there. I mean, we closed right on it on Friday. We closed right on it yesterday. And, we break that. I think you'll find a lot more people mentally go into risk off mode, because this is showing that the market itself is not able to hold up. But for me, 3,700, that's the line in the sand. We remain above that. I think you could still make a legitimate argument that the S&P is in an uptrend. We break 3,700, and I think you're hard pressed to make that argument very well.
Okay, well, this has been a market that has been, don't get out of stocks, just rotate. Do you think we're entering a phase if say, for example, we break down, where are people going to go? Because, they know they have to, and they're, it's illegal to go to cash with the market, right? I mean, you get fined. You have to do 30 days in county jail and then 100 hours of community service. So, I mean, to go to cash, what do you think they'll rotate into?
So here's the thing, and I get the argument. The debate is this just a rotation, and are people getting out of the high-flying technology communication service, sort of the FANG trade, and also things like the work-from-home trade, stocks like Zoom and Peloton, which have taken a bit of a beating, and rotating into sort of the old old school names like JP Morgan and Energy and, sort of the Dow names. And that's a decent argument. I'm looking at the Dow members now. And, for an Amgen that looks pretty ugly, for an Apple that's breaking its 50-day and breaking support levels, for Salesforce, which is broken down through its 200-day and keeps going. You also have something like Chevron at new 52-week highs. You have Disney not far off a 52-week high. You have Boeing, local Seattle company here, rotating back to the upside. So there are charts that are working. And as always, I tell people to lean into things that are working and lean away from things that aren't. And I'm still finding things that are working. I'm finding charts like, American Express that are breaking out to the upside, that you wouldn't know that the market's in trouble mode if you look at this chart. So I think
go ahead, David. No, I just find it ironic that what happened the last few months before these highs, possible highs, is that the two weakest groups out there were oils, because people were scarred from seeing futures go negative. So how can you ever want to buy oil? There's EVs, and the banks because of yields. They were the two laggards for years, and now they're the ones that seem to have the best looking patterns. You bring up American Express. It's not a bank, but it's financial. Do these credit card companies also benefit from higher yields just like banks do?
Everyone does to a point, and that's sort of the argument, right? When it feels like yields are really high right now. Interest rates are really high on a short-term basis. They are, right? They've come up from 0.5% to 1.5% on the 10-year. So that's a big move. But if you look at the historical trend in yields, we're still way at the lower end of any sort of long-term average. So interest rates can go a lot higher. And what happens is, in the short term, it's a very positive thing. It's definitely positive for banks. It's positive pretty much anything in the financial sector, to be honest.
That's what Paul has been saying, right? It means economic growth. Do you think, and I've heard people say, David, I'm sorry, I'm interrupting you. I do that. I do that because I forget things if I don't spit them out. That some people said Paul's last comment about the higher rates, that it's okay and it means that, we're having a recovery, it's a normal thing, is a policy error. Because, they think that he should be talking about that we're not going to let this happen. We're going to do everything we can to, not let rates go higher. Not that it's okay, because if it's okay, maybe the bond vigilantes will continue to press their case. Do you think he's going to backtrack today?
We'll have to see. We'll see what comes out of it. I think the general sense we've gotten from the Fed is we'll do whatever it takes to keep stock prices up, and I think that's going to be the most important metric that they're probably going to end up taking action on. And we'll see what happens if and this is the big question, right? If stocks really do sell off from here, and Amazon is breaking down through its 200-day and breaking down to a new swing low. Half of the FANG stocks are breaking down. A lot of names that have been doing very well, and also I would say the whole ARK Innovation Fund, these sorts of funds that have ballooned up, that have gone into a lot of names. If they get a lot of redemptions, they have to be selling a lot of stocks that have gone up really well. And while the market can hold up, and while stocks like American Express can go up while those other stocks are going down, at some point, people feel a panic and they start selling everything. They don't just start selling Peloton; they sell everything in their portfolio just to get out and preserve capital. That's when everything starts to get dragged down with it. And then we'll see what comments you get from the Fed to try to prevent that from getting really painful.
Yeah. What's the expression? You could own the best stock in a bad market, and it doesn't matter. Huh?
It's true. It's true. And so I think that, interest rates being where they are is still not a bad thing. That's actually a sign of a good thing. And I think you can see from a lot of financial stocks why that's okay. You can see oil stocks going up because of oil prices going up. But when interest rates get to a certain point, when the yield curve accelerates too much, it starts to not be a good thing. And that's when consumers start to feel the pain, and it's harder to borrow money, and it's harder for companies to borrow money. And that's when things start to get a little more negative. And that's when the negative effect of higher interest rates will happen. That's still a little ways off, I would say. But I'm more concerned about the flows issue of it. There are a lot of new entrants to the market and they're not probably embracing this whole rotation thing. They're probably seeing names that they've bought that start going down a lot, and there will be a panic, and that's when people just start selling stuff just to get out of it and preserve cash. And that's
what a great time to be putting together a shopping list for, say we get a 10-15% sell-off in the market. I know I'd be looking at commodity related stocks if that happened. I'd be looking at cannabis stocks if that happened. I think that if we get this sell-off, that we'll be able to buy the world. Something else that's shifting, I know you follow it through UUP, is the weak dollar has also been part of the bullish scenario in equities for, at least the last year or so. Dollar weakness. Well, since COVID, Dixie was 103 and now we're just, trading under 91. What's your look here on the US dollar? Does it, you're over your 50, so it's accomplished one thing here. Is that looking pretty good to you, David, for some type of bear market rally, maybe back to 93 to 95?
So I think that makes a ton of sense. What worries me about that thesis you just lined up is it looks a lot to me like August and September of last year, where you put in a new low at the end of September or the end of August. You rallied, you broke above the trend line, you pulled up a little bit. And that right there felt like, all right, the dollar's going to go back up to 97. We're going to.
I thought so then too.
And it made a ton of technical sense as well. And then it just stopped. And so if you look at that period versus this period, there are a lot of similarities there. And we're right at this point where we've made a higher low, which draws me in certainly. And then we start breaking higher. So is there a potential of us? And I would 94.80, which would be back to the September, 94.50. That would be sort of the October to September peaks back there. That's a Fibonacci retracement level. If you take the whole downtrend, you take 38% of the way, that's just below 95. So I think that would be quite a strong counter trend move that would shake a lot of people out. You could see a market distribution, you could see a dollar rally, and that would be sort of the bear market case in the short term. The S&P goes down to 3,200. That would be a meaningful drop in stocks. And I think to your point, it's, how are you going to react to that? In my time at Fidelity, the discussion was that was the best thing to happen. That's great companies at a bargain. And all of a sudden it looks like good stocks that you may have missed out on coming back to more reasonable levels. You don't have to worry about ridiculous valuations. You're buying it at decent levels again. And if you're bullish for the long term, which I am, I would argue the best thing to happen would be a nice, meaningful correction to sort of unwind a lot of the euphoria that we've seen.
Yeah, Garrett, some of these Reddit traders will really be looking for their $1,400 stimulus check to have ammunition again. I wanted to bring up the fact that before COVID, 10-year yields were 2%. So we're not even back to there. And you talked about it's mainly the velocity of the steepening of the curve. Do you have any kind of above 2%? I'm actually looking for a pullback in yields. I think we've completed this first wave. I could be wrong that we might pull back to, 1% again. And I think what might be behind it would be a stock market sell-off. So I'm wondering if you think there's any level, and maybe we've reached it here, that would really put a damper on growth in the market, because you could have disintermediation for a long time. You and I go back to 87, and remember the bond markets were in a huge bear market. The dollar was in a huge bear market while the stock market kept going up for disintermediation lasted months and months until it finally reached a tipping point. What do you think that would be, above 2% on the 10-year?
Yeah, and I think the scenario you just described makes a ton of sense. I tend to look at Fibonacci retracements on a long-term perspective, just to give you a sense of how far we've retraced some of these long-term moves. And if you take the November 2018 high, the March 2020 low in the 10-year yield, we're about 38.2%, almost exactly retracing that back up there. That lines up from the low sort of late fall of 2019. this would be a very reasonable place for there to be a break of sorts. The other thing I would look at is the TLT or the AG or one of the bond ETFs.
Yeah.
And what's happened there is you're nearing the low from fall of 2019. You're really in a rounding error away from that.
We took out the COVID crash low, and now we're trading above it. I mean, I was thinking that was a stop hunt. I think they're a buy here for a rally, maybe back to 150.
So I think when you're looking at bonds, I think you could totally make the argument for that. I think when you're looking at gold and gold stocks, you're seeing.
You're a mind reader. I've been pretty negative gold for a while, David, but we're reaching like 50% retracement levels. And if you look at the sentiment indicators, there's only like 20% bulls. I was thinking this might be a decent area, not to maybe marry it. I don't know if we're going to new highs, but maybe for at least a trade. And what a lot of people might get wrong is they go, well, the dollar's going to rally, so why would I want to buy gold? But all you have to do is bring up what's happened in the last, say, month or so. The dollar's been weakening and gold's been going down. Yeah. Right? Which you don't normally see.
No, and a lot of people, I would, as always, it's super helpful for us. We think it's helpful to simplify the relationship between gold and the dollar. Well, how could gold go up if the dollar's going up? And just as you said, I can show you plenty of examples where they move apart. I can show you plenty of examples where they move together. Over longer term periods, that relationship tends to be the case. But there are months and months where those relationships are not one and one. They'll change just because of the condition. Because it's not a relationship in a vacuum. There are a lot of other moving parts to deal with. With gold and with bonds, as a trend follower, I'm less excited about buying weakness like this, but if there's a time when I feel like a contrarian, it's now, when you've seen stocks that have had such a run and are showing clear topping signals. You have gold and bonds oversold and reaching key support levels. It certainly seems like a reasonable time, and the dollar starting to revert back higher a little bit. You can see that scenario where something like gold, where things like bonds actually have a nice little stretch during a market correction, an equity correction. It lines up very, very well.
Okay, and actually the silver shares, there's an ETF SLIJ. You'll see it probably has a stronger chart pattern than that was GLD, but I'm talking about you could pull up silver, but it's I'm looking at SILJ. Okay, there it is. See how much better it's holding up. I mean, we're probably at a 23% retrace on this. Not even see. So silver is still holding up better.
Way better.
Still think it could maybe go to 23, but it's holding up way better. And I think that's also another target. The Reddit, all those GameStop people came in and they were going to squeeze the shorts in silver, but no one was short. Retail was long. All right,
we missed the crucial piece of that puzzle.
Well, don't you think, David, there's a big difference between an individual issue and a global commodity market? That I'm even surprised that a social network could have that much power in the market to do what they've done. I don't know about you, but I was always taught to fade retail.
No, it's right. And I mean, when you look at these names and sort of how things played out, I mean, we can't doubt it anymore that a group of committed individual investors can have real impact on the market. We're seeing that. We're seeing the impacts of a group of individual investors grouping together and hitting one side of it. And what's interesting is the exact scenario that played out is sort of different, right? The way that it actually happened, the way social media was used, the way it played out with shorts was all different. But short squeezes have been around for quite a while, as you know, right? That's a well-known issue. The whole bubble
as they have pumps and dumps.
Exactly right, and the names have been different, and the structure's been different, but the bubble scenario, the idea that something shoots up and the initial idea is driven by a short squeeze, but eventually it's a bubble where you draw people in to chase it, and eventually the people that got in early are the ones that can sell, and the last people in are the ones left holding the bag at the top. And that's what you saw with a lot of these names with GameStop with AMC, and they've all had their secondary bounce now in the last week or two. But these don't end well. The left side of the bubbles are very good. The right sides tend to disrupt very quickly.
Okay, David. Anything else that you may want to share with us today that was on your mind and I took you off track?
No problem. I think, I mean, the other things I would say is, names that I think are important to watch here as you're tracking this equity unwind or potential equity unwind. There's a couple sort of buckets that I would look at. The S&P itself and seeing if it's able to hold its January low, 3,700. I think that's key. I think when that breaks, you start to see people get a lot more cautious. And I think that's when you can get a cascade of markets going lower because people go more into risk off mode, especially institutions will see that as a negative sign. The whole work from home trade, I don't want to say it's broken, but it certainly feels broken in the short term, and Peloton might be a perfect example. This is a stock that made a new all-time high yet again in October, in December, even in January, made a new 52-week high, new all-time high, and now has retraced from 170 down almost to 100, which is a big round number. So something like Peloton holding its 200-day, holding 100, that's sort of like the last level, right? Is it able to still be a legitimate stock that has upside, or was that just a thing that happened and now we need to totally reset? So I think that's one to watch there. And then, the last thing with Amazon, I think, the FANG trade, we can argue that, the market
dead since last August.
I was going to say, if you look, the Amazon topped in September. It topped at the beginning of September. Everything after the September market peak has not been with the FANG stocks really at all. Now, things like Google have done okay, but as a group, that was it. And that they got us to that point. From there, Amazon's been sideways, and now it's breaking down through this range that's been in for the last 6 months. The relative strength, looking at Amazon versus the S&P, it's been just down consistently. So this is not a new issue that, stocks like Amazon have underperformed. And my point is, in the short term, can the market rally without all of these big mega cap names? Of course, and that's what we've seen. We've seen stocks do okay. We've seen financials and energy, take up the slack and drive to new highs. But at some point, big mega cap benchmark names like this breaking down really start to have ripple effects. And it's where people take risk off, and all of a sudden there are a lot of redemptions in funds that own a lot of Amazon, and they have to sell a lot of their Amazon position.
Could go to 2,500, just looking at the width or breadth of that formation from around 3,500 to 29, breaking down here 500. Yeah.
So
prior highs.
It's not unreasonable that you see a much
halfway back.
And the same, I feel like it's the same thing with interest rates, right? Interest rates going up to a ways is a good thing. After a while, it starts to represent something more. And I think that's what you're seeing with stocks like Amazon. They've pulled back, they've struggled, but if they really start to break some key support levels and continue to rotate lower, I think that starts to drag everything down a little bit. But we should caution. I mean, all of these things that I mentioned, I think in some ways, the most obvious chart to look at, and I'll maybe leave you with this, is the semiconductor chart. If you look at the SMH, this chart of higher prices and lower momentum, this will be in future textbooks on technical analysis for one of two reasons. Either number one, it is the world's most perfect example of a bearish divergence that works out perfectly. And we break down, the SMH gets below 225, which would take it below its 50-day and below its January low. It is a rotation from bullish to bearish. And that's what I think is going to happen here. But option B is this bearish divergence does not work. Semiconductors recover and break to new highs. And all of a sudden it looks kind of like Tesla did, where you have all these false positives on the way up, and it really just continues to fuel this euphoric rise in stock. So that latter option could happen, but I think it's going to be more former. I'm seeing a lot of divergences in a lot of groups like this that feel like they're ready to go into distribution mode. And again, I think if you're long-term bullish, which I am, I think arguably that's the best thing to happen. We've had too much of a euphoric rise. You need backing and filling to sort of reset. And I think that's what we're looking at here in the next month for sure.
Okay, David, if you'd like to show your website, this would be a good time. And you could follow David at DKellerCMT on Twitter, and catch him on stockcharts.com. And David also has his own website that you could go to. And as you can tell, David gives very clean looks and doesn't really hedge his opinions and has a method to his madness. So you're at Alpha Research. Okay.
Yeah, marketmisbehavior.com is my website. My YouTube channel has the same name. And I always think of it, my goal is to help investors make better decisions. That's what I'm trying to do. And it's part of that is having a good technical toolkit, having a good set of charts to allow you to do it. The other part is, getting inside your own head, having a good conversation with yourself. And we work on a little of both.
Yeah, I found myself this weekend saying, "Be patient, Dale. Be patient, Dale." So we have to do the self-talk. So Brock is saying great interview. Others are saying great analysis, and your mission is accomplished, David, for what you're trying to do. You did it here today in F.A.C.E. Thank you, my trading warrior brother, for being here, and we'll see you again this summer. Appreciate your time
Take
today.
care, my friends.
All right, that's a wrap, everyone. Remember, don't just count your pips, count your blessings. Could join the guys for Morning Edge in about 20 minutes. Adios. You're welcome. You're welcome. See you tomorrow for the NFP.